5 ways rich people make money with debt. In finance, there are 2 types of debt: bad and good. Bad debt is money owed on depreciating assets with fixed payments that decrease in value. Good debt is defined as having an asset with debt that increases in value and/or generates positive cash flow above loan payments and expenses. All debt carries risk, but some debt rewards you for having it and others costs you to hold. Hello everyone, and welcome to a brand new video on the channel. Today, we are going to talk about 5 ways rich people make money with debt. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Debt can make you wealthy if you utilize other people's money to manage assets that increase in value and provide cash flow, which increases your net worth. Good debt generates leverage. For a tiny monthly price, you can own an asset worth several times the monthly payment. Your gain is a proportion of the asset you own, not your payment. Many businesses begin with business loans, allowing the owner to gain access to funds throughout the early phases of operation. While the banker owns the right to the debt's interest and payments, the business owner owns the business as well as the value of future earnings and cash flows. Debt provides people with the necessary capital to produce valuable assets. With debt and credit, anyone can be a capitalist. Leverage real estate. Purchasing real estate allows you to leverage your capital in multiples of 20 with 5% down payments or in multiples of 1,000 with monthly payments. A real estate investor can buy a $200,000 house for $10,000 down and $2,000 per month. Real estate investors earn returns on the entire loan amount, not just the money they invested. If the value of the real estate increases by 20%, from $200,000 to $240,000, the $10,000 down payment generates a 300% return when combined with the $40,000 investment return. Debt can also be utilized to purchase monthly rental homes or residences to use as Airbnbs, generating cash flow assets for monthly revenue through leverage. Cash flow returns are based on total debt rather than money invested in the property, resulting in high returns. Leveraged buyout. A leveraged buyout, LBO, occurs when the buyer or buyers of a firm incur a significant amount of debt as part of the acquisition process. The buyer will use the purchased company's assets as security to acquire the company, with plans to repay the debt later using the company's future cash flow. Following a leveraged buyout, the buyer acquires controlling stake in the target company. Short selling. Selling short reverses the typical order of purchasing and then selling stocks. Selling short is selling something you do not own. When you sell a stock short, you borrow it from your broker and then sell it to a buyer. You then owe the broker the shares. You receive cash from the sale, but you must spend it to buy shares later in order to repay your broker for the share loan. You are long cash and short shares in a short side trade. You are in debt for shares due to the credit available in your margin account. When you buy to cover a short position, the debit purchase price will be used to buy back the shares you were short in the open market, and your broker will be able to return the shares to the borrowed account. Today, everything is done electronically, using computers and automation. Short sellers reverse the trading process, selling first and then buying back later. If you sell short for a greater price than you later purchase it back for, you make a profit with debt. While shorting a stock, you must pay margin interest based on the amount of the transaction. You will also be responsible for paying any dividends due on the stock during the period in which you are short. This is how traders can profit from both the stock market's up and down movements. Margin account. A margin account is a form of brokerage account in which the stockbroker lends the investor cash or shares and uses their account as collateral to buy securities. Margin trading occurs when your broker adds buying power to your account, increasing the size and number of deals you can make. Margin can be utilized to increase the leverage of your trades or to speed up their turnover by eliminating the need to wait for them to clear after entering and quitting. If you use margin to raise the size of your trades, your outcomes will be amplified. If you trade twice the amount of the position you would have traded without margin, your profits will be twice as large, but your losses will also be twice as large. Leverage accounts enable investors and traders to roughly quadruple the size of their entire trade position if the stocks they purchase may be used for full leverage. Most crucially, margin allows day traders to maintain buying power without having to wait for all of their trades to clear. Using debt for living expenses. Investors might use debt to cover living expenses in order to avoid income tax and taxable events such as selling assets for capital gains. For example, they can obtain a margin loan from their broker without having to sell any of their stocks right now and then repay it later by selling equities that are down, resulting in no capital gains tax. High net worth individuals can also live on lines of credit secured by their assets and only repay loans from sources with favorable tax structures. For example, selling a residential residence which is not taxable in most states, selling lost investments, dividends with a lower tax rate than income, margin loans, or capital gains from stocks with a lower tax rate than a high-income tax bracket. How do billionaires live off loans? Let us use Elon Musk as an example of a wealthy individual who is maximizing their tax liability in order to profit from their debt-based investments. When the richest guy in the world is in need of money, he has the ability to borrow it and use it to pay for his living expenses or to purchase businesses such as Twitter. Instead of selling his Tesla shares and paying capital gains taxes on the profits, he can use them as collateral for credit lines. This prevents him from having to sell them. Since Musk's pledged Tesla shares function as an ongoing credit facility, they make it possible for him to access billions of dollars in cash whenever he requires it for whatever reason. What steps do wealthy people take to make the most of their debt? Wealthy individuals take out loans with low interest rates and have more control over their assets through the use of debt, which allows them to boost their capital returns. When they have a credit line that is sufficiently large, their assets and capital are only used to secure loans for the objectives of financial investment and business. In the same way that the money they borrowed generates returns and raises their net worth, their assets have the potential to yield returns. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up and do not forget to subscribe. Thanks for watching. See you next time.